Ever wondered why the world's economy fluctuates? It's an intriguing question, isn't it? The truth is, economic fluctuations are as inevitable as the changing seasons, a natural part of our global economic landscape. But what exactly are these fluctuations, and why do they occur? To answer that, we need to delve into the world of economics, where terms like bull market and bear market come into play. A bull market is a term used to describe a period of time when prices are rising or are expected to rise, named so for the bullish way a bull charges forward. On the other hand, a bear market is when prices are falling or expected to fall, named after the bear's habit of swiping its paw downward. These polar opposites represent the ebb and flow of the economy, the ups and downs, the boom and bust. It's a cycle that's been in motion since the dawn of civilization, even back when the barter system was the cornerstone of economic transactions. In those early economies, fluctuation was a simple concept. If a village had a bountiful harvest one year, they prospered. If the harvest was poor the next, they faced hardship. This was the birth of economic fluctuation, simple and direct. As societies evolved and economies became more complex, so did the causes and effects of these fluctuations. The bull and bear markets of today are influenced by a myriad of factors like government policies, technological advancements, global events, and even human psychology. So why does this matter to us? Because these fluctuations impact everything from the cost of your morning coffee to the value of your investment portfolio. They shape the world we live in, and understanding them can help us navigate the economic tides more effectively. In the end, understanding the past is key to understanding the present and future of economic fluctuations. So, as we journey through the history and intricacies of economic fluctuations, we'll be better equipped to face the bulls and bears of our modern economies. As societies evolved, so did their economies. From the rudimentary barter systems of ancient civilizations, where goods were directly exchanged, economies have come a long way. The adoption of currency was a revolutionary leap forward, introducing a standardized measure of value and simplifying transactions. This change in economic systems was driven by the need for a more efficient method of trade and brought with it a shift in the way societies functioned. As we moved on from the agricultural era, the world witnessed the birth of industrialization. This monumental shift was more than just about machines and factories. It was about the transformation of entire economies. It led to a surge in productivity, which in turn fueled economic growth. But it also introduced new complexities into the system. Economies became more interdependent, and the effects of economic activity began to ripple far beyond local or even national borders. The phenomenon of globalization further amplified these effects. With countries becoming more interlinked than ever before, an economic change in one part of the world could now have repercussions across the globe. This interconnectedness, while it has driven unprecedented growth and prosperity, has also increased the frequency and impact of economic fluctuations. These fluctuations, or the cyclical ups and downs in economic activity, have become a defining feature of modern economies. They are influenced by a myriad of factors, from changes in consumer behavior and business investment to government policies and global events. And while they can bring periods of prosperity, they can also usher in times of economic downturn. In essence, the evolution from barter to currency, the rise of industrialization, and the spread of globalization have not only shaped our economic systems, but have also led to more complex and frequent economic fluctuations. Understanding these changes and their impacts is key to navigating the ever-changing economic landscape. Now that we've seen how economies have evolved, let's delve into the causes of these fluctuations. So what causes these economic fluctuations? Well, just like a pendulum, economies too swing, sometimes towards growth, other times towards decline. But unlike a pendulum, these swings are not rhythmic and predictable, but rather influenced by a myriad of factors. One of the primary drivers of economic fluctuations is changes in aggregate demand and supply. Imagine a seesaw, with demand on one end and supply on the other. If demand increases and supply can't keep up, we see inflation, but if supply outpaces demand, we may see deflation. Both scenarios can trigger economic fluctuations. Next, let's consider technological advancements. These can be a double-edged sword. On one hand, advances can boost productivity, leading to economic growth, and potentially sparking what we call a bull market. On the other hand, rapid technological changes can also displace workers, leading to unemployment and potentially triggering a bear market. Political events too play a significant role in economic fluctuations. Policies, regulations, political stability, and even international relations can significantly impact economic trends. For instance, a change in government might lead to new economic policies that either stimulate or stifle growth. Similarly, political instability can create uncertainty, deterring investments and slowing economic growth. Lastly, we mustn't forget external shocks. These are unexpected events that can jolt an economy. Natural disasters, pandemics, wars, these can lead to significant economic fluctuations. For instance, the COVID-19 pandemic led to a major global economic downturn in 2020. Interestingly, these factors often interplay, creating a complex web of causes and effects. For example, a technological advancement might increase supply, leading to deflation. This could then trigger a change in economic policies to stimulate demand, leading to another swing in the economic pendulum. Now that we know the causes, we can explore how these fluctuations affect us. Remember, understanding the causes of economic fluctuations is the first step in navigating them effectively. Economic fluctuations aren't just numbers on a screen, they affect real people and businesses. When economies boom and bull markets charge ahead, there's a ripple effect that touches everyone. Individuals might see their stock portfolios grow, businesses may experience increased demand and higher profits, and governments might enjoy a boost in tax revenues. In a bull market, confidence is high. People feel wealthier, they spend more, and this increased spending can stimulate further economic growth. Businesses, seeing the increased demand, might expand their operations, hiring more employees and investing in new projects. But what goes up must come down. And when bear markets lumber in, the effects can be equally profound but far less enjoyable. Individuals might watch their stock portfolios shrink, businesses may see demand fall and profits drop, and governments could face budget shortfalls as tax revenues decrease. In a bear market, confidence wanes. People feel poorer, they tighten their belts and spend less, and this reduced spending can lead to economic contraction. Businesses, seeing the reduced demand, might scale back their operations, laying off employees and shelving new projects. But here's the thing, economic fluctuations are not inherently bad. They are simply a reflection of the cyclical nature of economies. Bull markets can lead to economic overheating, asset bubbles, and unsustainable debt levels. Bear markets, while painful, can correct these excesses, paving the way for more sustainable growth in the future. So, whether we're individual investors, business owners, or policymakers, it's crucial that we understand these impacts. It's not enough to just celebrate the bulls and fear the bears. We need to appreciate the role of both in our economic ecosystem. After all, without the bulls, there would be no growth. And without the bears, there would be no correction. Understanding these impacts can help us navigate the turbulent waters of the global economy. It can help us make better decisions, whether we're deciding where to invest our money, how to run our businesses, or how to shape our economic policies. It can help us ride the waves of economic fluctuations, rather than being swept away by them. So, how can we navigate these economic fluctuations? The key to successfully navigating economic fluctuations lies in proactive management and strategic planning. This involves a myriad of tactics, all of which aim to mitigate the impacts of these inevitable fluctuations on our investments and financial stability. A fundamental strategy is diversification. It's the financial equivalent of not putting all your eggs in one basket. By spreading your investments across a variety of different assets, from stocks and bonds to real estate and commodities, you can insulate yourself from the volatility of any single market. When one sector experiences a downturn, another may be on the upswing, helping to balance out your overall portfolio. Long-term investing is another crucial strategy. It's easy to get caught up in the short-term ups and downs of the market. However, history shows us that, over the long term, markets have a tendency to rise. By maintaining a long-term perspective, you can ride out short-term fluctuations and benefit from the overall upward trend of the market. Staying informed about economic trends is also vital. Economic fluctuations don't occur in a vacuum. They're influenced by a multitude of factors, from political events to technological advancements. By keeping a close eye on these broader trends, you can anticipate potential market shifts and adjust your strategies accordingly. Preparing for both bull and bear markets is another crucial aspect. Bull markets, characterized by rising prices and investor confidence, are great for growth. But it's equally important to be prepared for bear markets, where prices fall and pessimism prevails. By being prepared for both scenarios, you can protect your investments and even find opportunities for growth. By understanding and preparing for economic fluctuations, we can make more informed decisions and better navigate the global economy. The journey may be filled with twists and turns, but with the right strategies and a clear understanding of the economic landscape, we can ensure that we're always moving forward.